So yeah, good morning, everyone, and welcome to our fireside chat with John Doran and Florian Heinemann. I'm not sure if you already listened to some good talks this morning or if this is your first one, but I'm very sure that you are super excited for this upcoming talk. Before I introduce the talk and the speakers, I would like to encourage you to ask questions in the chat. I mean, this is your chance to ask these high-class speakers everything you ever wanted to know. So yeah, don't miss out on that chance. Well, worldwide, we already had about 250 IPOs happening this year. So we see that IPOs are great exit options for a lot of companies, which is why I'm super happy to have John Doran and Florian Heinemann with us today and talking about John's experiences at TCV and his learnings from 73 IPOs. So let me just say a few words about our speakers. So John Doran is a general partner at TCV. TCV has invested in over 350 companies, one of them being Spotify, Netflix, Revolut, and many more. But they've also helped a lot of companies to do a successful IPO. And this knowledge John wants to share with us today. Also with us today is our very own Florian Heinemann. I don't even know why I'm introducing him. We probably all know him, but let me just say one sentence. Florian is general partner at Project A Ventures. He co-founded the firm back in 2012. And throughout his career, he has invested in many, many companies and supported them with his knowledge and experience as a board member. So yeah, enough of me talking, and very warm welcome to Florian and John. The stage is yours. Please go ahead.
Thanks a lot, Christina, and welcome, John, also from my side. Basically, some words also about John, because I think you started the European operation of TCV roughly 10 years ago. Is that correct?
And yeah. First of all, thank you very much, Christina, and thanks for having me, Florian. Yeah, we started about 2012. We'd made one or two investments in Europe prior to that. A business called Sitecore, specifically in Copenhagen, which was a great investment for TCV. And on the back of that, we decided to open a permanent presence here.
Yeah, and I mean, you've invested as a firm. You've invested roughly $16 billion US dollars by now, and almost 20% of that went into Europe. Yeah, so that seems that like for a US based firm, you're pretty committed to the European market. Is that fair to say?
Yeah, I think that's absolutely fair. In fact, I think that understates it quite dramatically. If you look at when we first started. TCV's been around since 1995, and so we only started investing in Europe 2011 timeframe.
Okay.
And so it took us a while to kind of find our feet. And I would say more recently, it's been more like 35-40%, even more percentage of the capital that's gone into Europe over the last 7-8 years.
Okay. And so you're present in the US and in Europe. Are you also present in China or Asia?
Yeah, we've done some. We've made some investments there. We were invested, for example, in ByteDance, TikTok. You probably know that business pretty well. We've made some investments in Klook, also in China. We've made some investments in Australia, a business called SiteMinder. We were also investors in Xero, the accounting software business, and a few others. But we don't have a permanent presence there yet.
Okay, and how would you position TCV in the broader landscape of technology investors? I mean, Christina has already mentioned the names. I mean, this is basically all the household names we know today, or a lot of them in tech. You've been in. Can you describe kind of your investment philosophy a little bit and how you're positioned in the tech landscape?
Yeah, so we're a global investor, so one fund. We're quite active, I would say, which means we're typically often on the board. We don't have to be on the board, but we do want to have an ability to help the founders and CEOs that we're backing. We have offices in Menlo, New York, and London, covering the globe. In terms of where we're positioned, I think of us as a growth equity investor, and the mission around TCV has been pretty consistent over the last 25, 26 years, which is, and we call it our North Star, right? What is that? It's investing behind the best category-defining technology companies, high growth, driven by visionary founders and entrepreneurs. And I would say companies, you mentioned a couple already, Reed from Netflix, Daniel from Spotify, more recently companies like Nikolai from Revolut. these are the type of companies we really want to get behind and support as they go from, potentially, let's say 50, 100 million, 200 million of revenue to 500 and beyond.
And can you describe a little bit how you define such industry-defining companies and how you identify them? I mean, not really early. I mean, you probably earliest enter Series B, C, but I mean, how do you find those companies, and how do you make sure that you get in, especially in a very competitive market as we see it today?
Yeah, it's a great question. It's gotten only more competitive, as you know yourself. Our strategy has been the following. We try to be very focused. So when I say category defining, category leader, we try not to compromise on that. So we want to back the companies that we think are the leader or very soon to be the leader in a certain market. We look for three things always. Is it a category leader? Is the management team really, really strong? Is it a mission-driven founder, a mission-driven CEO, mission-driven management team? And is there big multi-decade tailwinds? We get all three of those things right, we feel pretty confident. How we identify those companies, I'd say it's a mix of both top-down and bottoms-up. On the top-down approach, I would say is our kind of more traditional TCV approach, which is for a firm of our scale and size, I think we're very focused. We focus on three categories: enterprise software, consumer internet, and fintech. And we're seeing, well, I'll come back to that in a second. We are seeing a lot of opportunity across all three sectors. We focus on those three categories, and everybody at TCV typically has some sort of domain knowledge or expertise, and we share that right across the whole team globally. So if someone's in the Valley or someone's in London, and the person in London might have an expertise in a certain technology vertical, we'll try and get that person involved in the opportunity. So we try to build, we try to utilize those networks to identify companies. We utilize to understand what's going on in markets. We build market maps, and we try to go, meet the companies in these various verticals, understand the strengths and weaknesses, and figure out where we think that the winner is going to emerge. I would say in the last 5 years or so, we've really kind of, I would say, augmented that effort, that kind of specialization. And for a firm of our size, by the way, being that specialized, I think is quite rare. There's a lot of firms of our size typically start to branch out into healthcare or into financial services or business services. We've tried to stay away from that and really focus on technology companies in the three verticals that I mentioned. The addition that we've brought is we introduced a group called the Data Intelligence Group, and that is really a group of engineers, data scientists that we brought on. Actually, one of our early associates was the pioneer of that effort, a guy named Aaron Ford. And what they're doing is using technology to overlay some of the domain expertise, knowledge, views on industries with real data that they can pick up in the market from databases all over the world to inform our thinking, to track companies, to allow us to, first of all, not just find these companies, but also when we do find them, to help them, right? When we're invested in companies, we're able to utilize this, I think, really proprietary and world-beating database to help these companies, both on the customer side, potential M&A opportunities, competitive intelligence, all of the above. So the tops-down, bottoms-up approach is really what we've tried to marry, and I'd say it has gotten more competitive. As you said, there's more capital coming in. It's really very difficult. We think that the being focused and sticking to what we know is the right strategy. Okay,
and what do you think about the current valuation development that's resulting from this competitiveness that we see in the market? I mean, do you consider this to be a bubbly type development, or would you rather say if you invested in the category defining leaders, it doesn't matter so much because of the value creation that's basically done by those companies?
Yeah, that is something that we as a firm talk about a lot. We talk about it because we try we have an expression internally at TCV. It's called FATE, F-A-T-E. Forget about the environment. It's really referring to the economic environment, right? Because as you said, we're investing for the long term. We want to take a view on the long term. And ultimately, we're trying to back, we think the companies that fit the criteria that I mentioned, which are category leaders in growing industries with visionary founders, that they will take market share over time and ultimately end up being seminal companies in their industries. If we get that right, we think we're going to be fine. You're right. It is at various times the valuations seem eye-watering, but I can tell you, investments that we've made even recently that appear to be eye-watering look, very, very good value even 12 to 24 months later, especially at the growth rates that we're seeing.
Okay. One thing that's kind of special about you guys, and I find that very, very interesting, and probably also we can share here. I mean, we've done 3 investments together, or basically we've been in companies, and then you came in. And I think one thing that really differentiates you guys is you're really in for the long game. I mean, even if you do an IPO, you stay with the companies very often. I mean, for as long as you can. I mean, to my knowledge, you're still invested in Netflix, although Netflix kind of IPO'd, I don't know, 8 years ago or 10 years ago, or whatever.
18 years ago. Yeah.
Okay.
Years ago. Yeah.
Okay. So why is that? I mean, why do you stay? Or has it paid out for you guys to have this really long-term view? And is that an advantage for the founders? Would you consider that to be something that is a relevant differentiation also for founders?
Yeah, I do. I think it's a big differentiator, and I think it's really appreciated. Let me tell you why we do it, first of all.
Yeah.
We do it because, if I go back to what I said earlier, what are we looking for? These companies that are category defining, special leaders in great markets. In our view, it really shouldn't matter whether it's private or public. We want to be a part of these opportunities, especially if we're seeing massive growth. And if you look at most of the companies that we've stayed with in the public markets, they've all been growing, compounders, big compounders over the years.
Mm-hmm.
So that's the first thing. I would say the second thing is I think that it is really appreciated. So you mentioned, I think Christina might have mentioned at the beginning of the call, we've had 73 IPOs in our history. More recently, we've had been very active this summer. We had the Toast IPO. We've had Sport Radar. We had Believe Digital in Paris, and we had LegalZoom also. We had 4 IPOs in the last 4 months. We've also had Nerdy, which was a SPAC that de-SPAC'd. So been very active in the public markets. And I would say, purely on the numbers, we've backed of the 73 IPOs we've had, I think we've backed 61 or 62 of those companies in the IPO. Okay. Right. And so we'll put more money.
So that means you invested again in the IPO.
So I think we were one of the larger investors in the Toast IPO, despite being one of the largest investors already in the company. We were the anchor investor in the LegalZoom IPO. We invested in the Sport Radar IPO. That's part and parcel of what we do, right? We think the other thing I would say is, which companies do you know best? It's the companies you happen to be on the board of, right? So we want to back our winners. And typically when companies are going from private to public, they tend to be winners. The other thing is, I would say we've been doing this for a long time. And actually the formation of TCV, this TCV used to be called Technology Crossover Ventures. So we used to say the crossover investing model was in our middle name, right? That was really the kind of genesis of what of the firm and how we got started. And we've continued that. And we think it's been a very rewarding part of our business.
Yeah. One thing that is probably also quite noticeable about you guys. I mean, you basically said you are very much focused on 3 areas and try to stay focused there. Can you describe a little bit of what you find interesting fields or interesting opportunities within those specialties that you currently see, where you see the constellation happening of tailwinds in favor of companies? Can you specify that a little bit for the audience?
Yeah, I can try that. First of all, I would say across all 3, we're seeing, I would say in my career, I've been doing this for over a decade, never seen a more interesting time to be an investor, never seen a more interesting time to be a technology investor. And across software, enterprise and SMB software, consumer internet, and fintech, we're seeing tremendous growth, innovation, like nothing we've ever seen before. One area in particular that we've been active, that maybe if we're talking about in the last 12 to 24 months, is on the fintech side. And I think there's There's a number of reasons for that. So we've made investments in companies like Mali, Revolut, Klarna, World Remit, now known as Zeps, Mambu, and others. Nubank in Brazil, Wealthsimple in Canada, Trade Republic, which we did with you, which thank you very much for allowing us to invest there. I would say the one thing that we're seeing more consistency across that is those companies and those fintech companies are doing a couple of things. One, they're offering better, faster, cheaper, more transparent fees, right? So for a long time, I think financial services has been the preserve of an elite few, right? And I think with a lack of transparency. So I think of 1.0 fintech in many ways as offering better, faster, cheaper. I think 2.0, which we're seeing now, is also offering a ton of additional services and engagement to customers that wasn't ordinarily available, right? So look at Trade Republic, look at Revolut. These companies are offering things like, very, very seamless, frictionless share trading, right? Things that were just the preserve of probably more wealthy elite people in the past. The fees that were associated with that, having brokerage accounts, was just higher. They're offering things like interbank FX rates. Again, some people had access to that in the past, but most people didn't, right? A great bank account service that's seamless where you can do multiple things yourself. Again, some people would have had access to that via maybe phoning up their private wealth manager or something, but most people didn't. So I think that democratization of financial services is happening, and it's happening big time in Europe. It's also happening all over the world. We're seeing that replicate itself. So that's a really interesting trend that I'm seeing, or that we're seeing. I would say the analogy I've used a few times, and I think it's pretty apt as a European. Growing up in Ireland, I remember the idea of going, traveling for a weekend to Rome or to Paris or to Berlin for a holiday with the family or something just was totally unheard of in the 80s, right? It was just a big production to go travel. And if you look at what happened in the 90s with Ryanair and EasyJet, you had this proliferation, kind of democratization of air travel, right? So people could just go and do holidays way more seamlessly and easily and cheaply. I think financial services, fintech is doing that for financial services. Things that were just not as easily available, lacking in transparency. Here's what you're paying for. I think that is something that's really happening. And then the other thing I'd say, which we really like in this category, is like with anything else, we think that when you see a rising tide or companies in a certain category growing all over the world, there has to be somebody powering these companies. There has to be like an infrastructure layer behind it, right? And so classic example could be e-commerce. One of the things driving e-commerce would be payments, digital payments, right? And so our investment in Klarna, our investment in Mali, they're two investments which have really benefited from the fact that more and more people are using online to transact. And I would say, similarly, our investment in Mambu is an attempt to try to benefit or ride some of the wave we're seeing around the core infrastructure behind some of these fintechs, the kind of embedded finance plays that we're seeing across the world. And Mambu is a kind of core banking technology solution which powers, I think, in Germany, N26, for example, as a neobank, and then also many other companies around the world. So they're kind of some of the key areas that we are spending time on. Fintech is just one that I mentioned because we've been quite active there, but across the three, we're seeing a ton of activity.
Yeah. Can you describe a little bit, what kind of check size are you getting involved in? What's like the minimum requirement for you there? What kind of stage do you typically invest in?
Yeah, this is a good question because we're rolling out some changes at TCV that are pretty exciting. So traditionally, I would say our current fund is about 4 billion. So our check sizes are anywhere from 50 to 400 million. That's kind of classic where we are. I would say most checks are in the 75 to 175 range, right, that we've invested. That's a kind of classic investment, and we'll typically build on that over time, right? So Spotify is a great example. I think ultimately we ended up having, a few hundred million invested, 300, 320 or something, maybe more, but the initial investment was 200. We added to that over time, right? So that's kind of a classic approach by us. So that is the main TCV strategy. We have launching a new velocity fund, which is really focused more on Series B type investments, and that's kind of $25 million tickets. So kind of the sub 50 million. And to your point, why are we doing that? Well, we're seeing a ton of really interesting companies that sometimes by the time it gets to the scale where we get involved, they don't need any more funding, right? And so in that situation, we want to be able to participate in some of those winners as well.
Okay. Can you describe a little bit how you see the German ecosystem, how you see your European ecosystem vis-a-vis also the US and China? I mean, you've always been dedicated to it since at least you've been around. Yeah. But do you see, like, comparatively, I mean, that's a big question always here in Germany. Are we, catching up? Is Berlin becoming the new Silicon Valley? Probably not. But is there, anything? I mean, do you see like a positive trend also, relatively speaking? Or do you see rather that Europe is, comparatively speaking or relatively speaking, falling behind what you see in the US and other markets?
I don't think about it kind of relatively speaking or falling behind or getting ahead, to be honest. I would say a couple of key points. First and foremost, no question, it is the most exciting time to be an entrepreneur in Europe. It's easier to start a company. There's more funding. There's more talent than ever before. And we're seeing it, right? Look, I don't have the numbers in front of me, but if you look at the amount of venture capital, growth equity that's being invested right across Europe, I think it's at record highs, and the number of companies that are, 1 billion plus, 10 billion plus in valuations out of Europe is at a record as well. I think Europe has a number of structural advantages that are playing into its favor. First and foremost, I think it's got great talent, some of the best technical talent around. I think if you go to the Valley, you'll see that a lot of the technical talent tends to be has been European, European technology guys, and I think hopefully more and more of those great founders and CEOs and technology leads stay in Europe. I think we're seeing that. We're not invested in Stripe, but the two Stripe founders are Irish guys, which I've always wondered, how do they end up in the Valley, coming from Tipperary, I think, or Limerick, where they're from in the south of Ireland, and it's amazing. I think if they were starting the business now, they probably would stay in Ireland, right? But back in the early aughts or 2009, whenever they started, I think it was much harder. And I think that is something that we're seeing, not just in Europe, but we're seeing that across the world today. Many more founders choosing to stay at home. Well, why would you do that? Well, I think one of the reasons is access to talent. The other reason, I think, is you have a lot less talent churn, right? So I think it's easier potentially in various parts of Europe, particularly Germany, to keep your talent. It's easier to there's not nearly as high churn as you might have, say, in the Valley. I think the cost is a lot lower. So I think there's a structural R&D advantage. If you think about, like, what are the advantages you can leverage to win in a global battle around winning a certain category, I think having cheaper, more efficient R&D resources is one of the things that you're seeing. And then the last thing I'll just say is TCV. We love the German market. We love the broader DACH region in general. We made a lot of investments in that region. Earlier we invested in Solonis. We invested in Trade Republic with you guys. We just actually the most recent IPO I've been involved with is a company founded by a German founder named Carsten Kurl, Sport Radar. He happens to have moved in the last few years to Switzerland, but he's German originally. We're invested in Flixbus, Flix Mobility. So there's a ton of investments we have in Germany. And I'd say the one thing I love about the German companies we've invested in, I've always said this, is they tend to be very technically strong. And I also think, at least in my experience, the German management teams that we've supported tend to under-promise, over-deliver, which I think is fantastic. It's a breath of fresh air. And so we love being involved. Actually, another one we invested with you guys is Spryker, right? Super excited about that one as well. So there's a ton of really interesting things happening in Germany, and I think we're going to be doing a lot more there in the coming years. Yeah.
I mean, one thing that's probably also interesting. I mean, you've always been a very big advocate of going IPOs, but at the same time, or going IPO, but at the same time, you see now that companies are being held private a lot longer. And one aspect that comes into play here is also the perspective of ESG. So Yeah. Because obviously, if you're listed in the public markets, it requires a lot of scrutiny and a lot more transparency. Which obviously, if the trend is towards more ESG, that also has an effect on that. I mean, how can you make sure, or how does TCV try to make sure that also if companies stay longer in the private sector, that ESG becomes a relevant perspective in those companies?
Yeah. Well, the first part of your question, I think, is there's a reason for it. Why are companies staying private longer? I think a big reason for that is just the returns into growth equity, into venture capital have been very good, and therefore more capital has flowed in, and which has allowed people to kind of stay private before seeking the public market. So that's not surprising, right? We're seeing that pretty much everywhere, I think. The second part, how do I think about it? I think it's a good thing. I think there's probably two big things that are happening, DE&I and ESG, and I think they're quite related. Why they're related? I think they're related because, actually, let me take a step back. I think they're related and they've been accelerated because of what's just happened in the last 18 months. I think ultimately what matters is the talent that are building these companies. None of these companies are built by, I focus a lot, and I've said founders and CEOs, but they're really built by a community, the stakeholders in a company, and these people in these companies tend to have values. They have a certain set of values that they care about, and I think things like fairness and sustainability and governance are top of the list today. And I think they've actually only really been pushed to the top of the list. I read an article recently in Wired called "The Great Resignation," which talked about the following, which is you've kind of had 18 months of people not really sure what to do, so they've kind of stayed put in their workplace. You've had 18 months of employers not really sure what to do, so they haven't gone out and hired. So there's kind of a big disconnect right now of people that want to move and also people that are looking for people, looking for talent. And you've also had, on top of that, the last 18 months where people, because they've been working from home, have had more time to think about what really matters to them, right? And so I think all of those things coming together have changed people's perceptions of what they want out of a career, the kind of fulfillment and so forth. And I think the things you've mentioned, diversity, sustainability, fairness, transparency, are all near the top of what people want. And if us as investors, or if you're a CEO, you have to listen to that, right? You have to kind of think about where's the ball going to be. I think it's only going to continue down that path. And let's be honest, it's a good thing for everybody, right? So we're very supportive of it. The great news here, Florian, is Europe is a leader in this, no question. So if I look at the companies that we're working with, whether that's Zeps, World Remit, Mambu, Klarna, Trade Republic, they are pioneers around ESG. For example, Klarna recently published its ESG report as a private company for the public to see. Another company we're involved with, Relax in Finland, takes this stuff very, very seriously, publishes their ESG report, their carbon emissions goals, etc., in a public way. So I think Europe is a leader here, and I think it's the rest of the world's only going to follow.
Okay. That's good to hear. I mean, there's a lot of entrepreneurs in the audience, obviously, and before we start with Q&A, which will roughly give us another 5 to 10 minutes, how can you best be approached? I mean, I mean, you get thousands of obviously business plans and ideas every year across the team, but what's the best way to approach you guys, and how can you basically increase the chances to become an item on top of the list of John Doran?
Well, first of all, we are typically a later stage investor, right? So I would say most of the companies that we want to get involved with already have product market fit. They already have typically a sales engine that's kind of working to some degree. And I would say most of the business we're involved with are kind of going from 5 to 10-ish of ARR or revenue before we really kind of get involved. But definitely reach out to us. Our website has all of our emails, tcv.com. LinkedIn is another way to reach out to us. Via people like you, Florian, at Project A, is another way to reach out to us. We love working with you guys. We've had, you reminded me, we've had three investments with you, which, and I think we're going to hopefully have more. I'm not sure there's many firms we've had that many investments with. So we love working with you guys and would love, in conjunction with you to talk to German or European founder CEOs. But yeah, reach out to us any way you can.
Okay. Sounds good. Christina, maybe we have like a couple of questions as far as I saw
Yes.
that there are some. And so we should probably get the audience involved as well.
Definitely. Thanks so much, John and Florian. Let's continue with a Q&A session. So John, first question that was asked is, do you think fintechs will consolidate towards one global mega financial service provider or rather stay independent?
It's a good question. We talk about that a lot. I think there's a couple of things happening. First and foremost, I think there's a lot of capital. And while there's a lot of capital out there, they all can't be winners, right? Not every company that in fintech or in software or consumer internet that gets funded today is going to be a winner. But there is a lot of cheap money right now. So I think we're going to see a lot of these companies that are not eventually going to make it continue to get funded for some time. But at some point, I think that will run out. The question then becomes, what will consolidation look like? I would say there's a couple of reasons why you might see some big global or regional winners within fintech. I personally believe that Revolut will be a big regional winner in the banking side. In Europe, I think Nubank will be a big regional winner. In Latin America, there'll be others in North America and be others in Asia. That said, I do think fintech in particular, because of regulation. So the thing is, a lot of these companies in fintech tend to be regulated, right? There's a lot of KYC, AML protocols you got to go through when you're handling other people, transferring money, for example, or dealing with people's money. And there's also, if you want to have a banking license or an e-money license or whatever license that might be, there's typically a regulatory body you need to report to. So I think that will partly keep it more regional based. In addition to that, I think due to the nuances around tech and infrastructure, we think of fintech as, a lot of fintech is quite hyper-local in some ways. And so you might see some consolidation, but I think it'll be on a more local level. I think in any industry, you often see a convergence around a winning proposition, whether that's one or two propositions. I don't think fintech will be different, but I'm not sure it'll be global. I think you might see it on a local basis or a regional basis. But it's just my kind of current thesis. I don't know, Florian, if you have a different perspective on that.
No, I think what's also good about fintech is that the markets or the profit pools in the various areas are so large that it's probably possible to finance or refinance a very strong tech infrastructure for certain verticals in it. I mean, there will be some consolidation, but I think it's different from e-commerce or whatever, where I think the trend towards consolidation or the forces towards consolidation are even stronger. And I think also the aspect of regulation, I think a similar space is digital health or the healthcare sector in general, where you also have a lot of regulation. And there you tend to see more regional kind of companies winning versus other not so regulated sectors. I think that I would agree with that. Yeah. So Christina, should we pick up the question on healthcare? I think that's also...
definitely.
Yeah.
So another very interesting question. I'd also like to hear your view on this, John. So what industries do you think have been neglected by startups so far, and where do you see untapped potential?
That is a good question. I think Florian's better at answering that one than me because he's an earlier stage investor. Not to kind of beat the fintech drum anymore, but I would say this is a classic example of where you had enormous market that was neglected for the longest time. And now we're seeing a flood of all that investment that took place 5, 7, 8 years ago coming through to today. So there will be others. Florian, you kind of hinted at one. I think healthcare in particular is one that we're seeing a ton of activity. We've not made a big bet yet in the category, and it's not for want of trying. I think there's a number of things that it kind of relates to what I said earlier around people's the talent of these organizations and what they ask for. I think there's a drive for kind of certain benefits, and I think one of them is health benefits, and whether that's related to physical health, but also mental health. I think both of those areas we're starting to see some really interesting activity pick up. The issue with I'd say the thing I think about here is while we're seeing a lot of really interesting healthcare startups, it feels like the US market is more conducive to this today, just because it's more of a private healthcare market. And in Europe, you kind of have more of a patchwork of different healthcare systems across the continent. I think ultimately there will be a European solution, and we're seeing a ton of really interesting companies across Europe that are doing things around insurance on the healthcare side. By the way, insurance is one category where there's a lot of fintech activity. I think a lot of it just relates to the healthcare insurance side, but I think that's one area that you'll also see. You'll see more activity in the next 24 months. But healthcare in particular, absolutely one, but I think Europe is probably a few years behind the US in that respect. Florian, you're probably closer to healthcare than I am. I'm not an expert, obviously.
Yeah. I mean, we also, we've done 4 or 5 investments in that space, and I think it's exactly what you said, John. It's not that easy to scale companies across Europe in that area. I mean, theoretically you could, with like the passporting laws in place, but if you look at reality, due to the patchwork of different regulatory regimes in the various regional markets within Europe, it's not that easy, and you don't see that many cross-European winners, as you probably see in fintech, which is also regulated, but where passporting of licenses appears to be easier and more sufficient to actually become successful in a given market than it is in healthcare. But I think it's still due to the sheer size of the market, it's very interesting. And probably one other sector that we see that is, I mean, you've also invested in it with Celonis, which basically is your business software bucket, is I think all the companies that invest in automation of the industrial sector, of that is all the digitalization of the value chains around the manufacturing sector in Europe. I think that is a huge, not untapped potential, because I mean there's some companies already involved, but if you look at just the sheer size of those markets and compare that to some of the industry defining companies we've just heard about, you guys have been involved in the B2C space, the total addressable market is much larger, and I think a lot of that has not been tapped yet. And I think it's also a strategic advantage in those markets to be positioned in Europe, where you still have a very diversified manufacturing sector, at least until today. And so the customers for those kind of products are often based in Europe, and not as it is in business software, where most of the largest clients are sitting in the US. So for a company like Spryker, for example, they need to go to the US sooner or later to become a relevant player. And I think that's probably different in that category, where serving the European markets probably will allow you to be really successful. Yeah. So
cool.
Yeah.
Thank you very much, you two. So I have a next question, which is very interesting. So towards you two, how to not get ripped off by investors as an entrepreneur? So looking forward to hear your answers.
You want to go first, Lauren, or me to go?
It's your show, but I can definitely also like provide my view.
Yeah, I mean, I think it's I'm not sure it's a fair question, actually. I think it's, if you think about it, I maybe I'd love to be challenged on this. In the history of the world, has it been easier than today to be funded if you're an entrepreneur? I don't think it's been any easier since than any point in history that I've come across, where you can raise really big amounts of capital to kind of back your vision on the least egregious terms. It feels like it's a great time to be an entrepreneur. And that would be my sense. How do you avoid being say ripped off? I think first, hopefully, there's probably two things I would say that you could probably do, two concrete tactical things. First and foremost, is spend a lot of time with the people you're getting an investment with. I often describe taking an investment, and for us as a growth investor, later stage, but even as a early stage guys, even more so, you're going to be with these companies for 4 or 5+ years. So I think of it as a marriage, right? And you're not going to marry the first person you meet, and you're not going to marry somebody without spending significant time with them. So that's the first thing I would say. Try to spend as much time as you can with investors to make sure that there's alignment of interest. I can tell you, I've not been in an investment in, I don't know how many investments we've done at TCV or me personally, that's gone up and to the right smoothly. Every investment has ups and downs. And so spend that time up front with whoever you want to work with, I think is really important to make sure that you get to you understand each other, that when things are not going to be as smooth, that you can work together. The second thing I'd say, and this is really important, is we do diligence on companies, right? We spend a lot of time talking to companies and talking to people that work for these companies, and talking to people who work with these CEOs, ex-employees, people, previous employers. And I would encourage any entrepreneur today that if you're going to take capital from TCV or Project A or anybody else, go talk to people who worked with them before, right? That's ultimately the best judge you can get that they're going to treat you fairly and be good partners. They're kind of the two things that I would encourage entrepreneurs today. But I would say, just the caveat, I don't think there's a better time to be an entrepreneur. I think it's a really exciting time, and it's great for Europe, and it's great for the world.
Probably just one last remark, and I think we also then need to come to an end. As John said, I mean, the competitiveness in the market for the best entrepreneurs really works in your favor, I think, as an entrepreneur, because everybody knows, and I mean, there's multiple examples of that. If you're really unfair to an entrepreneur today as an investor, it will become more and more difficult for you to get into the good deals. So I think every entrepreneur, every investor that understands that you're kind of in a multi-round game theoretically speaking, basically, will behave rationally and favorably towards you. And I think that is something that the competitive situation for the best entrepreneurs has really brought up even more. I mean, it has been the case always, I would argue, especially in the more developed venture capital markets in the US, but it's increasingly the same here in Europe. And I think that's why you can increasingly, I think, rely on investors. But I think it's still, as John said, I mean, the decisive moment comes when your company's not running that smoothly. So that's when that's the people you need to talk to, because I think do investors get nervous and kind of exacerbate the situation, or do they stay calm and rational and really help you to get out of this? Because as John said, I mean, any company I've been involved in that's today $1 billion company, and there were some, none of them was moving like a straight line towards that point. And I think those are the decisive moments, and you should inquire with people that have worked with the respective investor in such moments. Yeah. Maybe
can I just add one other point, Christina? I think you hit some great points there, Florian. You also made me think about the following. I often think about, I hate the word deal. We don't use the word deal here. We try to avoid it, right? I think of, we're trying to invest, partner. We love to partner with CEOs, with founders, entrepreneurs. I would also flip it on its head. The entrepreneurs, you should think about the investor you're bringing on as a partner, right? Not as someone that you should keep at arm's length. How can I partner with these investors to get to help me grow my baby, my business? And that if you think about it that way, I think you'll do the things I've talked about, which is spending lots of time with that individual, with that firm, meeting more than one partner, by the way, which I think is very important. Sometimes, Florian, you've been at Project A a long time, I've been at TCV a long time. That's not always the case. So you maybe, the partner you start with may not be the partner you end with. So I think it's important you meet more than one person. And then the references as well. So I think thinking of the the investor you bring on as a real partner, I think is important, that mindset.
Cool.
Cool.
Thanks a lot.
Thanks a lot for this finishing sentence. So unfortunately, time is up already. Well, we're already over time. So I need to stop the session now. Thank you so much, John. Thank you so much, Florian. It was super, super interesting. And also thanks to the audience for all the interesting questions. Yeah, have a great day at the PAKCon. And